Hi, I'm Rameez Ali, certified blockchain expert, senior executive at a crypto company, and author of Programmable Finance: The Future of Money in a Tokenized World. Welcome back to the Smart Money Stack, the podcast that demystifies the future of money. If you've been following along, we've covered blockchain, smart contracts, and tokenization. Today, we explore one of the most transformative components in this new financial stack: stablecoins, digital dollars on demand. Let's dive in. What are stablecoins? At its core, a stablecoin is a digital token whose value is pegged to a stable asset, most commonly the US dollar. If you've ever used USDC, USDT, or even DI, you've used a stablecoin. It's a crypto asset. But it doesn't swing wildly like Bitcoin or Ethereum. Instead, it's designed to hold its value. In a world where volatility and uncertainty are common, stablecoins offer stability without sacrificing speed, global reach, and programmability. Why stablecoins matter? Let's take a second to understand why this matters. Traditional finance relies on layers of intermediaries, banks, clearing houses, payment processors, to move money around. A wire transfer might take 1 to 3 business days. Cross-border payment? Add extra fees and delays. But with stablecoins, you can send digital dollars anywhere in the world 24/7, nearly instantly, for a few cents. That's a game changer. Types of stablecoins. There are 3 main types of stablecoins, and understanding their differences is key. Fiat-collateralized stablecoins. These are backed one-to-one by fiat currency held in reserve. Examples: USDC by Circle, USDT by Tether. When you buy 1 USDC, Circle puts $1 in a bank account or a short-term US Treasury to back it. Crypto-collateralized stablecoins. These are backed by other crypto assets and over-collateralized to manage volatility. Example: DAI. If you want to mint $100 in DAI, you might have to lock up $150 in ETH as collateral. Algorithmic stablecoins. These use algorithms and incentives to stabilize price without holding actual reserves. Example: USD Terra, which infamously collapsed in 2022. These are experimental and often risky. Each model comes with trade-offs in terms of transparency, decentralization, and risk. Use cases in the real world. Stablecoins are already being used at scale. Cross-border remittances. Migrant workers can send money home instantly without fees. Trading in DeFi. Most crypto trading pairs are against USDT or USDC, not fiat. Payroll. Startups and DAOs pay employees in stablecoins. Savings. In inflation-prone countries like Argentina or Turkey, people use stablecoins to preserve value. E-commerce. Merchants are starting to accept USDC just like credit cards. This isn't just theoretical. Stablecoins are moving hundreds of billions of dollars every month. Regulatory landscape. Of course, when money is involved, regulators take notice. In the US, regulators have proposed treating stablecoin issuers like narrow banks. Institutions that must hold 100% reserves, undergo audits, and offer full transparency. The EU's MiCA framework also addresses stablecoins, requiring licensing and supervision for issuers. Expect regulation to mature quickly, especially as governments look to issue their own central bank digital currencies, CBDCs, which frankly borrow many ideas from stablecoins. The big question regulators face is this: can private stablecoins safely coexist with sovereign money? Stablecoins versus CBDCs. Let's draw a clear line here. CBDCs are digital versions of government-issued currency, like a digital dollar issued by the Federal Reserve. Stablecoins, on the other hand, are issued by private companies or protocols. Key differences: CBDCs are centralized, controlled by governments. Stablecoins can be decentralized and run on public blockchains. CBDCs may be programmable, but stablecoins already are. CBDCs are still in pilot stages. Stablecoins are already live, moving billions daily. Risks and concerns. Despite the promise, stablecoins aren't without concerns. Reserve transparency. Does the issuer actually hold the assets they claim? Counterparty risk. If Circle or Tether went under, what happens to your USDC or USDT? Blacklisting. Some stablecoins can freeze your funds if required by law. algorithmic collapse, as we saw with Terra's USD. Not all stability mechanisms work. That's why due diligence and transparency standards are critical. Programmability. Here's where things get really interesting. Because stablecoins run on smart contracts, you can do things you simply can't with traditional money. Escrow payments, automated tax withholding, subscription billing that cancels itself, lending, borrowing protocols without human intermediaries, programmable payroll that splits your paycheck into savings, bills, and investments. Stablecoins aren't just digital dollars, they're programmable financial primitives. Stablecoins in tokenized finance. Now tie this to our last episode on tokenization. Stablecoins are the liquidity layer in tokenized finance. When everything from stocks to real estate is tokenized, you need a way to transact seamlessly between those assets, and stablecoins make that possible. Imagine tokenized Apple stock, tokenized Miami condo, tokenized art, and in between them, USDC or DAI, bridging every trade, swap, and payment. Stablecoins make tokenized finance liquid and accessible. In my book, Programmable Finance, The Future of Money in a Tokenized World, I talk about stablecoins as the digital cash layer of tomorrow's financial system. Think of them as middleware between fiat and the blockchain world. They're fast, they're programmable, they're transparent, and they're gaining adoption faster than most people realize. If you want to go deeper into this topic, how stablecoins integrate with tokenized assets, AI agents, smart contracts, and global markets, grab a copy of the book. It's your blueprint for the next decade of financial evolution. This podcast gives you the big picture, but the book dives deeper. With real-world examples, use cases, and frameworks you won't hear anywhere else. Reading it will help you fully connect the dots. Wrap up. Let's recap. Stablecoins are digital tokens pegged to real-world currencies, offering stability in a volatile market. They're used in payments, DeFi, trading, and remittances. They bridge the gap between traditional money and programmable finance. And while they pose regulatory and operational risks, they're undeniably reshaping how we think about money. In the next episode, we'll explore wallets, keys, and the ownership layer. Until then, I'm Rameez Ali. This is the Smart Money Stack. Stay curious, stay sharp, and keep stacking smart.